Yeah, absolutely. And thanks for having me on to do this. This is kind of an exciting topic for me because most of the time when I'm asked to present on something, I'm asked to present about how to buy a deal, how to get into a deal, how to find a deal, or how to raise money for a deal. It's not very often that I'm asked to talk about how to sell. And, it's one of those topics that you don't see a lot in the conference circuit. So kind of a cool thing to be able to talk about this. And most people don't want to hold a deal forever, and there's a lot of different things that are going to influence when you want to sell. It can be financing terms, market conditions, investor expectations. There's a lot of different reasons why you'd want to sell, and exiting means a lot of different things to different people, and minimizing risk and capturing or harvesting profits is only one of them. Before I get started, in the meat of the presentation, I want to get this out of the way. There's always a thing in these kind of presentations where, there's something for sale, right? Where what you're looking to do is to sell a course or a book or whatever it might be. And I just want to get that out of the way right now. I don't have anything to sell. So, this is going to be 100% just content. At the end, we'll have time for questions. The only ask I have, I'm gonna just put it out right up front. Couple of guys from Bigger Pockets with myself, we started a charity called aheroeshome.org. The purpose of the charity is to acquire and award a home, a fixed up home, free and clear to a deserving U.S. service member, first responder, or veteran. We're very passionate about this. On our team, we've got an attorney and an accountant that helped us form this 501c3. And all of this work has been done 100% pro bono. So all of the proceeds of any donations we receive are going to the core mission. And we're just very excited to be a part of that. So kind of a cool thing for us. And that's the only thing I have to talk about as far as what we're looking for. Just a quick background on me. You might have heard some of it if you were in the last panel. I've been investing in real estate for about 30 years. We've done about 700 single family homes, 2,500 apartment units. Right now, our current company profile, we have over 200 million of assets under management. Most of that's multifamily. We have well over 700 investor positions and have raised over $100 million of investor equity. Our current operational footprint is basically across the country, and then the three other partners in my firm have, when you combine their experience with my experience, we're at 106,000 units, I think it is, of multifamily experience in all the states on this map. So we've been around the block. We've managed to survive several market cycles and have done this without losing any investor principal. So I think that speaks to the fact that we're doing something right. Having said that, there comes a time in every investment's life cycle where you have to make a decision whether or not you exit or do you take profits. And this can be a complicated decision to make, but it's one that you got to make sooner or later. And you want to, ideally it would look like what's in this slide here, where you can see you want to buy at the bottom and you want to sell at the top, but it's never quite that simple. It always seems like it should be that easy, but it just never really is. There's a lot more that goes into it than just buying at the bottom and selling at the top. One of the reasons for that is because you never really know what the cycle is going to be. This is really what market cycles look like. Market cycles are scattered. Different asset classes are trading in different phases of the cycle at any given time. There's also, with the same, in the same asset class in different geographical markets, they could be at different points in the cycle where you could have multifamily doing really good in one state, but not so good in the other, or office might be doing really good in one section, or office might be doing really well kind of nationally where multifamily isn't doing well, or retail. And so all those different things create just a hodgepodge of cycles. So a lot to think about when you're thinking about exiting a deal. There's really two different kinds of exits. There's the planned exit and there's the unplanned exit. The planned exit just means that the movie is over and it's time to go. The unplanned exit basically just means the movie theater is on fire and it's time to get the hell out. So let's talk about a few different exit strategies and kind of how these apply to different business models. There's the fix and sell strategy. So this is the strategy where your typical value add, where you buy the property, you improve it, increase the NOI, and then ultimately you sell the asset. After that, there's the buy and hold forever approach, where you literally have no exit strategy. And this is kind of common in the family office space, where you might have $100 million or $1 billion family office. They buy real estate. That real estate produces income, and they never have any intention of selling any of it. That's another exit strategy, is not to have one. There's the buy, fix, refinance, and hold strategy, and this is a common one even in the value add space, where you buy the asset, you improve it, that in turn increases the property's value. Now you go out and get a refinance loan to take out your original financing, plus be able to return some of the equity back to the investors. And that is, in fact, an exit strategy. You're exiting some of the capital. Maybe you're even lucky enough where you can exit all of the capital. But regardless, you're still minimizing your downside by doing this, by taking some capital out. You can't lose money that's no longer in the deal. So, the buy, fix, refinance, and hold strategy is a valid exit strategy. My favorite exit strategy of all is the buy and watch exit strategy. And this is one where we buy the property, we improve it, we increase the income, and then we watch the market and we watch the property's performance for the most opportune time to exit. And this could be early in the investment, or it could be later in the investment. And I'm going to show you some things here in just a minute that help to determine which is which and when you might identify the most opportune time to exit. And then the last one is improvise. And this is really what you have to do when you're trying to survive an adverse market cycle. And boy, we had to practice this one in all kinds of ways in 2009 when there was a massive market collapse. And really what you're doing here is you're just trying to preserve equity. You're trying to last. You're trying to stay occupied. You're trying to keep as much income as you can. And you're trying not to lose assets to the bank or have to hand the keys back. And you really are just having to improvise and make decisions. And it's one of the reasons why I say that experience goes a long way in multifamily syndication, especially if you have experience in market cycles, because boy, an adverse market cycle can hurt a lot worse than what you'd think. And as a result of that, you have to be able to think on your feet, come up with new and innovative and sometimes bold ways to make sure that that you can make it across to the other side of the cycle. So assuming all those exit strategies, why do I think so much about exits? I started this in this business in the house flipping side. And, when you're flipping a house and you're trying to determine how much you can pay for that house you're going to flip, the very first question that you have to be able to answer is, what can I sell that house for? And once you know what you call it the after repaired value. So what's the house worth after you've bought it, fixed it up, and resold it? What's that after repaired value? So what you do is you take that value and then you subtract, the profits you want to make, you subtract how much it's going to cost to fix it up, and your holding costs and all those other things, and that tells you how much you can pay for the house. So I just carried that philosophy with me into the multifamily space, and I underwrite and acquire multifamily property very much the same way as I acquired flips. The first thing I'm thinking about when I'm looking at multifamily real estate is, what can I sell this property for when I've executed the business plan, and when should I sell it, and what will that price be? So let's walk through a couple ways on how you do that. The first thing you're doing when you're underwriting real estate to acquire is you're looking to forecast the income. And so when you draw out how much rent you think you're going to be able to get for each of your units, even after you fix it up, how long it's going to take you to get rents to those rates, how much you can compress expenses, all those different things, and you arrive at an NOI, a forecasted NOI. What you should be doing when you're evaluating these assets to purchase is you should be forecasting the NOI, both the gross income, the expenses, and the net operating income for every single year that you intend to hold the property, and even beyond. If you think this is going to be a 3 to 5 year hold, underwrite your income all the way out to 10 years and put that into a chart so that you can see exactly what you think the property is going to do over the course of the ownership period and out for 10 years. And you're going to factor in rental growth, expense growth, all those things are going to go into this calculation. The next thing you want to do is you want to determine, based upon that net operating income, how much do you think you could sell the property for in any of the years that are on this chart. And determining a sales price is really a formula. Even though when we buy, there's a lot of factors that go into determining how much we can pay for real estate. Generally speaking, those prices are going to fall to some range of cap rate. So the best way to forecast your exit price on a go-forward basis is to use an exit cap rate. And I'm going to talk a little bit more about exit cap rate in a second, but let's talk about what cap rate is and how to calculate it for those that aren't familiar. The cap rate is you take the net operating income that we just calculated, you divide it by the cap rate, and that equals the sale price. So in this case, let's look at year one. We have $1,214,473 of net operating income, and we have a cap rate of 5.5%. So when we divide the income by 0.055, that equals a sale price of a little over $22 million in year one. Now, where does this cap rate come from? That's a really, really good question. Cap rate is not a number that you make up out of your head. It's not a number that you think you want to buy for or you think you should sell for. Cap rate really is a measurement of market sentiment and what the market is willing to pay for any given income stream. So let's assume that when you've acquired the property, the cap rates in that market, based both on your purchase price and on the appraisal, are somewhere in the area of 5.25%. And so now we're going to assume that when we go to sell, we're taking the value add component out because we're going to improve the property ourselves. Maybe we leave some meat on the bone, but we're taking some of the meat off the bone. We're not going to get quite as good of a price. So we know it's probably going to sell at a little bit higher cap rate than what we bought for. So we're going to just assume, and this is a little bit art and a little bit science, we're going to assume 5.5% cap rate. Now, as time goes on, cap rates might move, and they might move up, they might move down, we don't know. So again, back to a little bit art, a little bit science. It's a matter of trying to estimate what you think the cap rate might be in future years. So if today the cap rate's 5.5, or let's say 5.25, at year 5, we might be looking at a 5.9. So we've got a little bit over 0.5% cap rate movement in 5 years. Maybe you're going to forecast it would be 6.5. This really has a lot more to do with your tolerance and your risk tolerance and the margins of safety that you want to build into your underwriting. The higher the cap rate, the lower the purchase price, and conversely, the lower the cap rate, the higher the purchase price. So each year here, we've mapped out the sale price of the property based upon the net operating income and an estimated cap rate. And each year we have a resulting sale price. Now, it's right here, it's just kind of a bunch of numbers, but if you graph this all out onto a line graph, it looks like this. And you see that when we first buy the property, its value is somewhere around the neighborhood of 22 million, and 10 years, it's almost up to 30 million. But what's most interesting is you'll notice that the line takes a pretty steep climb in the early years, and then it takes a turn and it curves and flattens out in the later years. Now, I call that inflection point where the line turns that corner. I call that as basically your optimal point of sale. And I'm going to get to why in just a second. So this is our optimal point of sale right here. Now, talking about why, the property essentially goes through 2 phases. The first phase, which is encompassed by this section of time when the value is increasing rather rapidly, I call that phase 1. In phase one, we're actually doing things to the property. We're doing physical things to the property and to the management and the operating expenses and the income that make a difference. In other words, we're upgrading units, we're improving amenities, we're enhancing the curb appeal, doing all kinds of things that make the property look nicer and more attractive to tenants. We then are able to capture higher lease rates. When we re-rent the units, we get a higher rate than we did from the last tenant that was in there. And as we did that, we've increased the income. And when we increase the income, by virtue of that cap rate formula, we're increasing the sale price. But there's a point when you're finished with it all, and now you've upgraded all the units and you've improved all the amenities and you've enhanced the curb appeal, and there's really nothing else that you can do to improve the asset. So at this point, this pricing curve starts to flatten out because you're no longer forcing income. Instead, now you're relying solely on the market. So phase two is where the property is just relying on, say, 2% rental rate increases or 3% rental rate increases or whatever the market happens to be. That's what goes on in phase two. So there's this inflection point where the property shifts from phase one to phase two, and that really, is what I define to be the optimal exit point. So if you've ever wondered why it seems that most value-add operators tend to forecast a 3 to 5 year hold, this is one of the reasons why. If in the first 3 years you've done most of what you can do to improve the asset, the time period between year 3 and year 5 really is mostly letting those changes propagate through the rent roll, have the income and expenses stabilized and proved out on a T12. Those are the things you're looking for from year 3 to year 5. So since most of that movement happens during those years, a lot of syndicators and a lot of investors, they want to see a 3 to 5 year exit plan. After that, you're no longer in value add mode. You're just in market mode, and nobody really wants to rely entirely on the market. We all want to be able to force value or do something. Now let's look at another way to try to look at your exit timing and determine the best point of exit. After you've forecasted your sale price, and you have, this is the same chart that we had a couple slides ago, forecasting our exit price. The difference here is below the exit price, we have a line for cost of sale, which really is like your resale commission, closing costs, that sort of stuff. And then you have your loan balance. So, in this particular case, we obviously had a refinance loan because you notice that the loan balance jumped from year 2 to year 3, creating a cash out refinance scenario. So you're subtracting your loan balance from the sale price, you're subtracting the cost of sale from the sale price, you're adding back in any cash reserves that you held in on hand, whether that be cash in the bank, cash in an impound or escrow account, or a rehab reserve account. And then that results in net sales proceeds. So you're mapping out every year for 10 years, what would you net in your pocket if you sold in that year? And then you're adding to that the forecasted income, the net income after debt service, all the cash flow for each year during your hold period. And when you add those two together, you can calculate the internal rate of return, or the IRR. So if you go through and you map out your IRR for every year of your hold period as if you sold it that year, you'll notice that the IRRs tend to peak right around that time when you're finishing your value add of your deal. So in this case, the IRR peaked at the end of year 2, and then it started to drop off. So if you're an IRR driven investor, you can see here that the optimal time to exit is at month 24. So 2 years into the investment. It's pretty hard to execute that. That's a pretty narrow time frame. So a lot of people aren't able to exit until year 3, which does drop the IRR down. But if you held on to year 5, year 6, 7, 8, or all the way to year 10, that IRR can drop even further. So if you're an IRR-based investor, the sooner you can get in, improve, and sell, the more return you make on your money. Now, if you're a cash flow investor, this might not matter. You might not be a IRR driven investor. Instead, what you might look at is your cash on cash return. And then if you can get a refinance at, say, year 3, pull some cash back out to minimize your downside, and then watch your cash on cash return for the next 5, 10, 8, 12, 20 years, or however long you want to hold, that you can continue to hold as long as you are getting the cash on cash return that you're looking for. Now, one thing I will say about investors with that strategy is that over time, as the value of the real estate continues to go up, your cash on cash return might be acceptable, but your return on equity declines. In other words, the amount of money that you're earning for the equity that's in the property is getting less and less every year, and as that property value goes up. So there's a point where it actually benefits you, even though you're a cash flow investor, to sell, harvest the profits, reinvest your principal plus the profits into another property where you can do this value add scenario again, protecting your downside and even increasing your cash flow even more. So there's a few different influencers on when you exit a deal. One of those is your financing terms. If you have a fixed rate loan, and this is kind of a famous one, and one of my pet peeves is if you're going to do a 3 to 5 year business plan and you have 10-year fixed rate agency financing in place, you're going to have a yield maintenance penalty in most cases on that financing. And that yield maintenance penalty can be pretty substantial. We recently bought a deal where the seller had to pay over $1.5 million in yield maintenance penalty to pay off their 12-year loan that they were 2 years into. So it can be very punitive to have long-term fixed rate financing. You can mitigate that in a variety of ways. My favorite way to mitigate it is by using floating rate longer term financing. So you have 7 to 10 years horizon on the maturity, just like you would on fixed rate, but you have interest rate exposure. And really what you're doing is you're trading one risk for the other. We're trading interest rate risk for yield maintenance risk. But what we're doing here is we're taking away an influencer on deciding when the optimal time is to exit. And remember, I said my favorite exit strategy is to buy and watch. I want to buy the asset, watch the market for the optimal time to exit. If I determine that the optimal time is at the end of year 3, the last thing I want is $1 million prepayment penalty on my loan to influence that decision if I think the timing to get out is now. So financing terms definitely has an impact. You know, on the flip side of that, you could have, let's say you've got a 3-year bridge loan. Now you get to that kind of year 2 point, and you have to make a decision. Do you sell before it's time to refinance that bridge loan, or do you go and refinance the bridge loan and hold for some period longer? So again, that financing is influencing your timing on your exit. Another one is market conditions. Market conditions has an intense influence on exit timing. If you think that the market's about to crash, you might want to sell and harvest profits. If you think that the market has a lot of legs left, then you might want to hold on. And so one thing that we look at is job growth in the market, population growth, and income growth. When those things start to taper off, you might think that you're starting to reach a top. Kind of more up to the moment indicators is to watch vacancy rates and rental growth rates and concession values. So if vacancy rates start to climb and rent growth starts to decline and concessions start to increase, that could be an indicator that the market is weakening, and it might show you that now is a good time to get out. On the other hand, if you didn't recognize it in time, or you were unable to sell at that point in time when you saw that coming, and now you're in the middle of an adverse market cycle, now the market conditions might influence your exit timing, because you might look and say, look, if we sell now, we're going to sell at a really steep loss. However, we're cash flow neutral or cash flow positive. We can hold on and ride out this market cycle, come out the other side and sell at the next market cycle peak. Again, those market conditions are going to influence the timing of your sale, and you just need to watch all of those indicators for what they're telling you. And then last is investor expectations. If you've told your investors this is a 3 to 5 year hold, you're probably not going to want to just blow right through that date without saying something and hold it for 10 years because they're expecting to get their money back. So it's really good to deliver on what you've promised to your investors. And, if it's a 10-year hold and you sell at year 3, but you gave them extremely outsized performance and you achieve your, 5 or 6 year objective by year 2 or 3, at early exit is usually very welcoming. But nobody really likes to have a 2-year investment turn into a 10-year investment. So what your investors are expecting is really important. If they're cash flow investors and looking for a long-term hold versus IRR-based investors just looking for capital growth, those things are all going to make a difference. Now, how do you price the deal when you've determined, okay, now is the right time to get out? There's several considerations that I want you to keep in mind. First is the exit cap rate. We talked a little bit about how to estimate an exit cap rate earlier. This really is a little bit art and a little bit science. It comes down to what the cap rates were at the time that you made your purchase and forecasting where they might be. But once you're in the hold, now you're going to be looking at what cap rates are actually doing. And so we've had a lot of deals where we forecasted higher exit cap rates, and then we get 2 or 3 years in and the higher exit cap rates didn't materialize. They actually fell. And now that's a bonus, right? Instead of getting a 6 cap, it's a 5 cap, which is, like a 15% or so increase in market value over what you expected to achieve. So dipping your toe into the water and figuring out where cap rates are today is really important. Looking at trades, talking to brokers, appraisers, and just kind of following cap rates in general is going to help you in your pricing. Always remember that deals that don't have a value add component will generally trade at a higher cap rate than deals that do have a value add component. So keep that in mind. If you bought a value add deal and fully improved it, your exit cap rate's probably going to be higher than your acquisition cap rate, even if market conditions and investor sentiment is the same. Another consideration is adjusting for property taxes. And this is a common mistake that I see in underwriting is you take your net operating income and then you look at the current cap rate environment and you estimate a resale price. But what you fail to consider sometimes is that the property taxes your buyer is going to be charged are going to be different than the property taxes you're paying in a lot of states. Now, some states like Arizona don't reassess on sale. Here you might have like a 4 or 5% increase of the assessed value. But in other states like California, for example, California is one of the biggest, this is one of the best examples. If you had a property that was held for 50 years, its assessed value is based on the price it sold for 50 years ago plus a 2% growth rate. And now that price is enormously higher. So you've got to take out the old property taxes, calculate what the new property taxes will be for the buyer at the estimated sales price, and then put those property taxes into your income calculation to calculate your sales price. Now you can kind of see a little bit of circular math that has to happen here because the property tax affects the NOI affects the sale price affects the property tax, which affects the NOI, which affects the sales price, and so on. So you got to do a little bit of kind of these iterative calculations where, our model calculates, it'll do like 1 million calculations in a couple seconds as it zeroes in on finding that combination between value, property tax, NOI, and cap rate. Market versus marketed. There's a sense that off-market deals trade at a lower price than marketed deals. I don't buy it. Off-market deals almost in many cases get a higher price than marketed deals because you've got to get a price. Let's say you're a buyer, you're going to pay a price that's high enough to encourage the seller to not put their property on the market. In a hot market environment, that's very difficult to do. So sometimes off-market deals will trade at an even higher price, or at least at an equivalent price. So off-market versus marketed really is a decision based upon how much effort you want to put into the sale, what your exit timing looks like, or how strong of an offer you get from an off-market buyer. And then there's priced versus unpriced. Do you advertise the deal with a price or do you advertise it without a price? In the lower price brackets, call it under $3 million, give or take. Most of the time those deals go out with a price tag. When you get above that price, more often than not, those deals are not priced, especially in hot markets. They're just letting the buyers bid against each other until they get to the price that they're looking for. So whether you go out priced or unpriced is a little bit of a philosophical decision. Most of the time we go out unpriced. So how do you choose a broker to sell the property for you? Really, it comes down to who's a broker that's a specialist in the asset class and size that you're selling. If you're selling a 200 unit property, you don't want the guy that only sells 40 and 50 unit deals, and vice versa. Having somebody sell your 20 unit that normally sells 200 or 300 units could be a mistake because they might not put as much focus on your asset as they do their other listings. I also like to focus on who got me the deal, and I believe in what comes around goes around, and rewarding somebody that brought you that deal by giving them the listing when it's time to sell. I also believe in rewarding them for bringing opportunities. If somebody brings you a really good off-market deal, throwing them a bone by giving them a listing as a way to say thank you is also that's also a really good thing to do, as long as the broker is a specialist in that size and asset class. You also want to look at their track record and their ability to sell in that market. You want top brokers that sell a lot of product, a lot more than you would want the guy that nobody knows who he is. Now, let's say you've put the property out, you get an offer, and now it's time to interview the buyers and figure out who's the best buyer. We had a lot of conversations about this on the last panel of how do you pick which buyer you're going to choose when you get a bunch of different offers. And the way we do it is you have a phone call interview process with the top buyers. And during this phone call, you're going to get a chance to ask a series of questions. And normally, the broker is going to run point on this call and ask all the questions. And as a seller, you generally sit back and listen to the answers. But you always get the chance, if you want, to throw in a few questions of your own. But generally, these questions are going to surround these main topics, with the first two, source of equity and source of debt, being the two questions that are the most intensely focused on during the buyer interview call. What you want to know as a seller is, where is your buyer getting their debt and where is your buyer getting their equity? In other words, how are you going to pay for this? Do you have to raise the money, or do you already have it? Is this a 1031 exchange, or are you a family office, or just what is it? You have a fund and it's discretionary, or do you have other decision makers that haven't seen the property yet? How is this equity coming to you? That's kind of key question number one that everybody really wants to know. Aside from those two really important questions, the business plan for the property, what you want to know is, does the buyer's business plan make sense? So a business plan means we're going to buy the property, we're going to enhance the curb appeal, and then we're going to upgrade the amenities, and we're going to renovate the interiors of the units. We're going to spend $5,500 on each of the interiors of the units. We're going to put a new roof on, and we're going to hold it for 5 years and increase rents. That's our business plan. What your job is as the seller is to decipher whether or not that business plan makes sense. Because if their business plan makes entirely no sense at all, then that tells you that the buyer is either inexperienced and doesn't know what they're doing, or they have a bad business plan that might not be well received by lenders or sources of equity. And now you give them a yes, but the lender or the equity source gives them a no, and you're right back to square one, going back out to market looking for another buyer. And the last thing you want is a false start. You want to know about their renovation scope, their renovation budget. Part of what you're trying to figure out here is, are they applying enough money to do what they intend to do? And is there money in their budget for them to address things that are wrong? Like, let's say the property needs new roofs, but when they're talking about their renovation scope, they're not saying anything about adding roofs, and they're not budgeting anything for roofs. That's a key indicator to you that they're probably going to end up retrading this deal, because during the due diligence phase, they're going to send a roofer on the roof. They're going to discover that it needs a new roof, and they're going to come back and ask you for a credit. And so this is kind of that common scenario where you're in a multiple offer situation and you've got 5 buyers and they're all like within 50 grand of one another, and then one guy is $200,000 higher. And you're like, gosh, that's the guy you want. He's $200,000 above everybody else. We're going to pick him, plug him in. But really all he's doing is offering you the highest price with the intent of retrading at the end of the due diligence period. And he's going to try to get a $300,000 credit. And now you're $100,000 lower than the 4 other buyers that you had. They were, kind of all right around that same grouping. So you want to try to sift that out during the buyer interview call and figure out who has too small of a budget or an inadequate budget, and factor that in when you're making your decision. Another one is, do they own other properties in the market? That's always a plus if they do. That means that they're familiar with the market, probably have more knowledge of rental rates in the area and occupancy levels than buyers that don't. It also means that sources of equity and debt are going to favor them a little bit more. Just gives you a little bit more confidence that they're going to be able to get to the closing table. How many properties they also have in contract now tells you a little bit about how distracted they're going to be. If they're like, we've got 15 properties in due diligence, you're just one of 15 now, and that could be really problematic because next thing you know, you're going to get to day 29 of a 30-day due diligence. They're going to ask you for a 30-day extension because they haven't been able to get to it yet. So learning a little bit about how available they are to pursue this opportunity is really important. And then ask them about previous retrades and cancels. How many times have you had to go back and ask for a lower price or a credit? And how many times have you thrown a deal in the trash can? This tells you a little bit about their track record and heads up into what you can hopefully expect when you get into escrow. Now, let's say you get into contract. What do you need to have ready for the buyer? Essentially, if you think about your due diligence checklist when you buy a property, that's what you want to gather up when you're getting ready to sell. Have ready for them stuff like T12, rent rolls, service contracts, surveys, anything you have in terms of inspections, insurance loss runs, warranties on anything that still is under warranty, any leasing brochures and floor plans and capital improvement lists. I mean, the list goes on and on. Probably one of the most difficult to gather up is 1 year of all utility bills. It usually requires someone sitting there and running them all through a scanner and putting them into PDFs. But almost every buyer is going to ask for those. Same goes with service contracts. Have all that stuff ready. If you have Dropbox or some kind of file sharing program, it's good to put all those due diligence materials into that file storage so that you can share that link with them once you get into contract, and that takes care of all of your due diligence deliverables. Now let's go into kind of the final distribution and wind up of your entity. What happens after the sale is closed? What do you do with your money? Do you just take all of it and distribute it out to all your investors and close the bank account? I absolutely not, in my opinion. There's a whole process that you need to go through here, and you got to follow the steps carefully, or otherwise you can find yourself getting bit in the worst way. So first things first, you got to calculate your waterfall, determine how much money goes to your investors, how much is earned to the sponsor through a promote, and make sure that the waterfall calculations that you're using follow exactly your operating agreement. And this is a very common mistake that sponsors make, is they use some off-the-shelf waterfall calculation, or worse yet, they just wing it or don't really know how to calculate a waterfall. These can become enormously complex, and there's a lot of variations in waterfalls in terms of cash flow priorities, like what comes first, pref or return of principal, and then how the different tiers work. So just make sure that the math in your waterfall calculations exactly matches the words in your operating agreement. Otherwise, you could find yourself getting in an investor lawsuit because you shorted them capital that they were entitled to. The next thing is you make an initial distribution after closing. I usually make this distribution a couple days after closing, but I hold back a ton of money. A deal like, let's say we sold something that was $20 million. I might withhold $500,000 from the capital when I make this initial distribution. And that money sits in the bank account until about 60 to 90 days after closing. And the reason for that is during that 60 to 90 days after closing, you're going to have utility bills that come in and various expenses that trail in. You'll have a vendor that, oh, gee, I forgot to send you this invoice from 6 months ago. This is due, or whatever the case may be. All these things are going to come up. You want to make sure you have the capital to distribute to your to pay those bills, and you didn't distribute it all to investors, because the last thing you want to do is go to your investors and ask for money back, or pay these expenses out of your own pocket because you made a mistake and distributed too early. The next step, at the end of the year, you'll complete the tax return. You'll pay any outstanding taxes that are due, and most of these entities are flow-through entities, and the investors themselves pay the taxes on them, not the sponsor or not the entity itself. But most states have some kind of state franchise fee, and sometimes those fees can get really pricey. We've had them as high as about $20,000 because you had this large gain on sale, and they tax you based upon gross revenue or gross receipts or the amount of the gain or whatever the case may be in that particular state. That bill can be big. So you want to complete the tax return and pay all the taxes. And so when you make that second distribution 60 to 90 days after closing, you're still going to want to hold back quite a bit of money. We tend to hold back anywhere between 50 and 100,000, depending upon the size of the deal, until the tax return has been completed. Once the tax return has been completed, we still hold back money to cover unexpected costs. So we'll get the tax return done. We'll pay the state taxes. We'll pay the CPA firm for completing the tax return. By now it might be 6 or 8 months after closing. We can assume most all bills are paid. So we'll make another distribution to the investors, but we still hold back somewhere between anywhere $10,000 to $25,000. If on a really large deal, it might even be a little bit more than that. And we tend to hold that for about another year. And the reason that we do that is you never know what can come up. And we've had stuff happen where you have a bill that comes in from a vendor that's like 2 years old, and they got lost, or they forgot to bill you or whatever. Or you get a case where somebody files a lawsuit, just nuisance bogus lawsuits that you have to defend, and there's legal costs, and you want to make sure that you have money in the entity to cover that. A tenant claims some mold or some kind of liability concern or whatever the case may be. You want to have some cash in there to cover legal expenses. After you're kind of past that safe point, and that the statute of limitations, then you can make that final minor distribution. And even if it's $25,000 on a per investor level, it's usually a really small check. But you'll make that last distribution to empty out the bank account. Also, at some point during this, you're going to cancel your entity with your local Secretary of State in the state that the entity was formed in, and so that you don't continue to rack up entity charges for your state. Once the final distribution is made, we tend to leave a couple dollars in the bank account, like $1 or $2 in there, as long as the bank has a free account and doesn't charge us monthly fees on the bank account. Just in case you get a check. This happens every once in a while where you'll get a check just randomly from who knows who, and you want to have a way to be able to negotiate that check and deposit it in your bank. So we usually keep the bank accounts open for a couple of years, and every once in a while you'll get a check that comes in, and then you get to surprise your investors with a check for $5 or something. So there's that too. See, we kind of went through all these different holdback considerations, trailing expenses, post-closing true-ups. What that is after you've closed, your buyer can come back to you even, 6 months later and say, oh, hey, we just got the property tax bill. We prorated it based on last year's taxes. This year the taxes are higher. So, you owe us the prorated amount for that additional property tax bill, which is true. So you got to be able to send them those funds. And, again, you don't want to pay that out of your pocket. And you don't want to go back to your investors and make a capital call. Then finally, I want to talk just briefly on 1031 considerations in a syndicated investment, kind of a common question. It's really unlikely that you'll be able to do a 1031 exchange in a syndicated investment. Generally, everybody would have to agree to do a 1031 exchange, and the entire entity and all investors in it then buy a replacement property and invest in the replacement property. So yes, it can be done. I've found that, if you've got a deal that has 80 investors in it, getting everybody on the same page is a bit like herding cats. It's probably not going to happen. So, and the other consideration is you as a sponsor, how do you get your promote out of the deal? There are ways to do this, but it gets very convoluted and complicated. It can be done. It just can be a real pain. So if there's a huge gain and a lot of a really large tax bill, it might be worth that pain. Other times it's probably a lot easier to just sell, pay the tax, move on, buy the next property without a 45-day gun to your head to acquire your next asset, which might cause you to overpay by what your tax bill would have been anyway. Another strategy is called a drop and swap. This one's also really kind of complicated to execute, but essentially what it is the members of the LLC drop all of their LLC interests into a TIC interest, where now they own a direct deeded interest into the real estate in proportion to their percentage of ownership of the LLC. And then each of them can do their own 1031 exchanges as a tenant in common owner. I'm not a tax expert, so I can't give any advice on all the intricacies involved in executing a drop and swap. I do know that they're very complex and complicated to do, and you need to have somebody that knows what they're doing in order to execute it. We've never done one, and I don't ever plan to, but that is an option that may be available to you. That kind of rounds out everything I had prepared to talk about, and I think now we can open it up to questions. And Dan, I'll give you the floor.
Sure. Yes. Thank you so much, Brian. Great information there. One question that did come through from a couple people is would you be able to share your slides with us?
Yes, I can. Absolutely. I'll get those over to you, Dan, and then you can share them with the group.
Okay, great. Well, if you want to send them over to Stacy, you probably have her email, Stacy at Multifamily Investor Nation. She will make sure they're attached next to the recording inside of the forum. So for those of you who are looking for the recordings, they're in the mfinforum.com. If you need your login for that because you lost the email or something like that, you can email Stacy at Multifamily Investor Nation, STACEY, and she will do that. So if you have any questions here for Brian, please do type them in now. And we'll stay on as long as we need to be able to answer as many questions as possible. So I know this is the last session of the day, so everybody's kind of anxious and ready to get out. But I really do appreciate you, Brian, actually participating as a panelist, but also coming in and also presenting on this particular topic, because you're right. I haven't been to any conferences where this is a topic that they actually talk about how to, once you're in a deal, how do you get out of the deal, right?
Yeah, it's true. And one of the funny thing is, and I think I even said something about this in the panel last hour, was that it's as hard as it is to get into a deal, it can be even harder to get out of a deal that you really want out of. Especially if you're in a market that's kind of slow, it can be a real pain. I mean, I've had stuff back in the day. I remember holding on for years longer than we intended, just because the market was in the toilet and there was just really no viable exit strategy. So talking about the risks of exiting and thinking about when to exit is it's an under-discussed topic, but it's just as important as getting in.
So another question in here is coming from Alex saying, are you still looking to buy in 2019? And how do you feel on where we are headed, especially in the Southern California market, would be helpful?
Yes, I am still buying. We've already closed 539 units in acquisitions this year in 2019. We have another close to 200 in contract. It's likely that we'll close 1,000 units this year on the acquisition side. We also have some exits that we're preparing for that, we'll either begin that process here in a couple months or at the latest early next year. So We're net buyers. We're still looking to buy more assets than we're selling, but there's a lot of legs left in certain markets. So I think, to the second half of the question about my opinion on the Southern California market, I can't render that great of an opinion on the Southern California market because I'm not really there. I've got 2 projects in the Southern California market, and that's it. We're selling out of both of them. California is a market that I have completely taken off of my radar, thanks to the constant threat of rent control and all kinds of political attacks that are happening on the multifamily front. There's just much better places, in my opinion, to put capital than California. So we're out of California entirely. Having said that, I believe completely in the thesis that selecting a market is entirely reliant upon the job growth, income growth, and population growth in that market. And, there's 2 different market cycles. There's the economic cycle and there's a demographic cycle. And the economic cycle is rather rapid and unpredictable, and it can shift on a dime. So we know that we've kind of gone through a really large up economic cycle. So, a down economic cycle is certainly a risk factor, but a demographic cycle is much different. It's like turning around an oil tanker. They move very slowly and they tend to go for a very long time. So if you can find where and is for jobs, plenty of upside left.
So the next question here is can you share a story of a difficult disposition and any creative solutions that you had to come up with?
Boy, a difficult disposition. In the last 5 years, there really hasn't been no such thing as a difficult disposition. In general, everything you put on the market's going to get 10 or 20 offers. And, all the stuff we're buying are in very strong markets, top 50 MSAs nationally. So, we really have not had a lot of difficulty selling. Having said that, I was in this business in 2009 through the worst of the market cycles, and I've kind of been there and done that. One example of a property that we had, everybody wants to know, like, what was your worst deal? My worst deal was a property that I bought in 2009, and I bought it for half the price the guy paid in 2005. So you'd think that was a great deal. But, the economic cycle had some punches left in it that, I didn't see coming. And by 2010, the income and occupancy of the property fell dramatically. The property wasn't even worth the loan amount. And there was really no exit strategy that was viable. I could not sell because, I owed more on the property than it was worth. It got to the point where the property's cash flow paid the expenses, but there was zero money left for debt service after the expenses were paid. So you get sandwiched in this place where it's like, there's no money to pay the loan and I can't sell. What do you do? Now what I did, and not everybody would or could do this, but what I did is I started making the $15,000 a month mortgage payment out of my own pocket. And I did that for about 4 years while the market recovered. And when the market did recover, I was then able to sell. And when we sold, we not only got a price high enough to return all of our investors' capital, we got enough to return all of the money that I loaned into the company to pay the debt service for that 4.5 years. So, and the investors even got a small single-digit annualized return. So, that's when I talk about, improvise was one of the exit strategies. That was a clear case of improvise, and you got to do everything you can do. I mean, you might have to pull a capital call to your investors and ask them to invest more money to keep the deal alive, or else it has to go to foreclosure. Or you can, step up and make the payments. I mean, that's not always possible, especially, on a $20 million deal where the payment's $100,000 a month.
Well, and I think, that's also, some people say, well, why do you have loan guarantors on there that have to meet certain net worth and liquidity requirements? And that's a great case as to why they want that, because they don't want to not have that requirement in there and just have anybody in there, but they can't they don't have that, ability to put in $15,000 a month for the next 4 years to be able to make that deal float.
That's exactly right. Those net worth and liquidity requirements show the lender two things. One, it shows them that you've had some level of business success to be able to achieve that. And second, it shows them that, if things go really wrong, you have some other resources. And, that's important to lenders. They don't want the very first thing, to come to mind to be like, things aren't going well. Let the bank foreclose, non-recourse loan. What do I care? They want to at least have some assurance that, you have other alternatives available to you.
Well, that's one thing that I talk to my investors about as well, because they'll say, well, what are some other questions that I should be asking, other groups before I, join with them on a passive investment? And one of the things I always tell them is make sure that they have had some form of success in their background in business, because at the end of the day, we're buying a business. And you have to understand how to run a business and how to work with people and how to actually put systems and procedures and processes into place to make sure that that asset will perform the way it needs to perform. Because we're buying a business and it just so happens to have an asset associated with it, which makes it kind of a nice little cherry on top, if you will. But at the end of the day, we're buying a business, and you want to make sure you have people on that sponsorship team that know how to actually run a business.
Absolutely true. I mean, if you were buying a manufacturing business, and that manufacturing business had a bunch of machinery, that machinery is the asset that produces the income for that manufacturing business. And if you've never done manufacturing before, chances are you could fail. So, you got to have some kind of success in business, because you nailed it. This is a business, and there's decisions that have to be made all along the way. And, another way I put it to people is, if you had to have heart surgery, one of the first questions you probably have for your surgeon was, have you ever done this before? And how many times have you done this? And what has the outcome been? Have people lived through it, or do they usually die? That's what I would want to know. And I would sure feel a lot more comfortable if the surgeon said, look, I've done 25,000 of these surgeries. I've got a 99% survival rate and, a really good, post-surgical outcome, versus having them say, gosh, this is the first time I've ever done it, and I'm not really sure.
That's a very good point. Very valid. And, I use the same scenario when patients in my offices will sometimes, when I was working in the offices, they would ask, well, do you guys have any guarantees or any refunds? And that was one of the stories I would tell, but I would kind of say it as a fact of, if your heart surgeon goes and does surgery and you die, do you get a refund?
Yeah, that's exactly right.
It doesn't happen that way.
Yeah, and it's not going to do you any good even if you do.
No, absolutely. The next question here is from David, and it's kind of dovetailing the earlier question about the market and the economy. Are you more cautious now in the 2019 market? He's located in DFW.
Yeah, absolutely. 100%. I've actually been more cautious for the last 5 years. After what I went through in 2008, the way I approach income real estate entirely changed. Everything I look at, the way I underwrite real estate, the way I protect downside, completely changed after 2008. Because once you feel pain, the last thing you ever want to do again is feel pain if you can find a way to avoid it. So, I've done a lot to try to change how I look at real estate, 10 years ago versus the way we look at things today. And, we were cautious in 2013 and, thinking like, gosh, we've had a couple years run up here. Prices are approaching, pre-recession peaks. What does that mean? And, so we were already cautious then. I'm not a sky is falling. I'm just waiting for a shoe to drop, or I've got all my cash hoarded so I can go in and scoop up, half price deals kind of guy. I think that strategy is likely to fall flat because I don't think that's going to happen. But I do think that an adverse market cycle, whatever shape that may come in, is likely to be encountered during the hold period of any asset acquired today. So we want to have a plan that if that happens, what's our plan B? Have we underwritten, financed, and all these different things in a way that's going to allow us to ride out an adverse market cycle and sell at the next market cycle peak. If it doesn't, then that's probably a deal we don't want to do.
And that's actually Richard's next question is how are you mitigating that downside risk on either those new acquisitions or even some of your existing properties?
Yeah, one of them is, study carefully the market average vacancy rate for the submarket you're looking to buy in. And you can get this from some of the paid providers like Axiometrics and those guys. It will tell you like this submarket over the last, since 1996, has averaged, 91% occupancy. So if occupancy today is 97%, are you underwriting to 97 or are you underwriting to 91? Because that's the long-term average. Also, another thing to look at is what was the last adverse cycle trough? So, in 2009, was occupancy in the submarket, did it get down to, 84? Where was it? And then compare that to what's your break-even occupancy rate. So, one of the things we run calculations on what we call a default ratio, which takes, how far can income fall from our forecast before it hits a 1-to-1 debt coverage ratio. And that's called the default ratio. So if that default ratio is over about 82%, it starts to increase the risk of the deal. If it's over 85, it's probably a non-starter. Anything below that, that your income can fall 15 or maybe even 20%, and you still have a 1-to-1 debt cover.
And obviously, you're going to definitely have not very good returns at that point with your investors, but you're not going to lose the deal.
Well, I have two jobs, right? My first job is not to lose people's money. And we have to keep in perspective that is our first job. Our second job is to earn our investors a return. And of course, everybody wants and expects to earn a return. But, if there's a cataclysmic economic event, investors understand it's very unlikely that the returns that were forecast to them are going to materialize. But boy, if you're with a sponsor that comes out the other side and earns them a return, you're a hero. So when we sold that property we bought in 2008, it was supposed to be a 3 to 5 year hold. It turned into an 8.5 year hold. When we sold the property, I sent our investors a check. They got all their money back plus a small profit. And you should have heard the reaction. I mean, people were like, oh my God, I wrote this money off years ago. I never thought I would see it. They were thrilled to get their money back because they knew what happened in the market. They knew there was no way that there was any chance that, they could earn a 17% return, like we had originally thought we were going to get. So first step, don't lose people's money. Second step, try to make them money.
Next question here is what's the difference between a waterfall structure versus an equity split structure?
Well, there really is no difference. The term waterfall is really a slang for, what happens to the funds, the cash flow that comes out of the asset level. So when you've got an apartment property that's throwing off cash after debt service, where does that cash go? It goes through what we call trickles through the waterfall. Now, an equity split structure is kind of where you say, we split the profits 50-50, right? That's what people might call an equity structure or an equity split structure, or it's a 70-30. So every dollar that comes out, 70% goes to the investor and 30% goes to the sponsor. That's still a waterfall. It's just because waterfall is slang. It's just a very simple waterfall. Now, waterfalls get increasingly complicated. The next step up from that simple waterfall would be one where you say the investor gets an 8% preferred return and then a 70-30 split. And what you're saying in this case is the investor gets 100% of all the cash flow that comes from the property until they reach an 8% return on the money that they invested. After having met that test, any cash over and above that is split between the sponsor and the investor at whatever the ratio is. So in the example I just gave, it was 70-30. Now, waterfalls can get increasingly complicated because you can have more tiers than that with more hurdle rates. So you have like our typical waterfall structure, and this is probably on 3/4 of our deals, is an 8% preferred return followed by a 70-30 split until the investor reaches a 12% return. Cash that comes out after those two tests have been met is split 60-40 until the investor receives a 15% return. And then after that has been met, any cash over and above that is split 50-50 between the investors and us as the sponsor. So that's basically like a 4-tiered waterfall. You've got your pref and then your 3 hurdle splits. And these can be as simple or as complicated as you want them to be. The reason that we use the structure that we do is because if the investment underperforms, it favors the investor because they have the preferred return to fall back on. And if the investment overperforms, it rewards us for having done so by giving us a higher split of that additional cash flow.
Do you guys, in your 8% preferred return, do you guys have a catch-up?
We do not. No, we do not have a catch-up. A catch-up is when the investor gets 100% of the cash flow until they reach an 8% preferred return, and then the sponsor gets 100% of the cash flow until they've been distributed an equal amount as to what the investors have received, and then there's splits that follow. It doesn't have to be dollar for dollar. It might be you get 50% until you've reached an equal amount. I mean, there's a bunch of different ways to do it. But generally speaking, no, we do not have a catch-up provision.
Okay. And there's 2 questions on here that are fairly related. It's about, one is a broker that is looking to build his business through multifamily sales. And then the next one is really about somebody who is a newbie investor and what should they focus on when trying to acquire their first deal.
Got it. So for trying to become a broker and break into this business as a broker, really what this is about is, it's about having a real deep knowledge of finance and underwriting and how multifamily works. But more so, being a broker is really just a relationship business. So it's all about, who do you know that might be a buyer and who do you know that might be a seller? Because at the end of the day, what a broker is doing is matchmaking buyers and sellers together. So if you don't have, a list of sellers or a list of buyers as an audience for you, you need to build one in order to become a successful broker. One of the ways that people become successful brokers and build those lists is they go to work for a brokerage shop. Like Marcus and Millichap is famous for this, right? For some people, that's an entry-level brokerage position where they go in. They're kind of low man on the totem pole or low woman on the totem pole. And they build their kind of client base over a number of years as they do deals. And then eventually they either branch out on their own or go to work for another firm or build their own team or what have you. So that's really how, the brokers tend to get started in the large multifamily space. For the would-be buyer, it's all about track record. And what that means is in order to get awarded a deal, you need to convince the selling broker and the seller that you can execute on the transaction. And usually that means telling them, this is where I'm getting my equity. This is where I'm getting my debt. These are the deals I've done, and this is what I own in the market. So the best ways to do that is to do any deal you can do. And if that means you have to buy a house, a rental house, or a duplex, or a 4-plex, or a 10-unit, or whatever it might be, to have a presence in that market and say, oh yeah, we own 25 units in this market. So when you're buying a 50-unit deal, that's very plausible that you can execute on the 50-unit deal. Now you got 75 units. Now when you go to buy a 150-unit, you're like, we got 75 units in that market. Building it over time slowly is perfectly acceptable. You don't have to listen to gurus that say go big or go home, only buy 500-unit deals or whatever the case may be. Buy whatever you can to get yourself established in the market and build a track record so that you can convince buyers, sellers, and investors that you can execute.
So the last question here that we're going to take for this session, we only have about 5 minutes left, is from Richard, and he's saying he wanted a little bit of a clarification on the waterfall structure side of things. How does the waterfall that you just described, getting the sponsor to 15% on cash flow, affect the capital gains distribution on sale or a refi?
Doesn't affect it in any way whatsoever. So when you are running the math for the waterfall, every cash flow event runs through the waterfall according to the rules set forth in the operating agreement. So let's say, for example, the waterfall says that the investor is first paid 100%. It means weather gets fed into that waterfall, and first thing that happens is it goes towards distributing that 8% preferred return. After that hurdle is met, every dollar after that is split 70-30. Now, if that's the sale, well, actually, let me take that back. So if it's a refinance or a sale, usually after that pref tier has happened, the next step is going to be to return the investor's capital, obviously. So, let's say you refi at year 3 and you get out half of the investor's capital. The first thing that happens, they get caught up on their pref. The second thing that happens is they get the balance of those funds, 100% of it, as a return of their capital. The sponsor gets none of the refinance proceeds, unless, of course, the refinance proceeds exceed the total investor commitments. On the sale, kind of the same thing happens. If there's any investor money left in the deal, the first thing that happens is that investor money gets returned to the investor. After that, it sifts through the waterfall. It satisfies the pref, and then it goes into the 70-30 tiers. Now, the rules on this can get very specific, and they're different in one operating agreement to another. Sometimes it's return of capital first, preferred return second, and then split tiers come third. Sometimes it's capital return first, then pref. Sometimes it's pref first, then capital return. Sometimes it's capital return only on refinance or sale. Other times, even cash flow will qualify as capital return. So, there's as many ways to structure this as there are deals. And that's why you don't just go to, some website and pull off an operating agreement off the website and use that. Because these are custom tailored to the specifics of every deal and how you want to structure it and what your investors will agree to let you do.
Well, thank you so much. I really appreciate all of these answers, these questions that have come through, as well as the answers that we've been able to have from Brian here. Thank you, Brian, so much. How can people reach out to you if they want to follow you further or connect with you further?
The best way is through our website, praxcap.com. It's praxcap.com. On that website, there's some forms on there, they can fill out to contact us and either subscribe to our blog, which also will put them on our list to receive anything we send out by email, or for accredited or non-accredited investors that want to get to know us, there's forms in there that you can fill out that send it directly into our investor relations department to reach out and have a phone call and an introduction and get to build a relationship with you as an investor. So either of those ways.
Awesome. And I went ahead and put it into the chat box there as well, so people can easily click that to go to your website to find out more information about how to connect with you further there as well. Brian, thank you so much for joining us. I hope you have a good rest of your evening, and looking forward to having you at the next summit.
Looking forward to it too as well, Dan. Thanks for having me a part of this for the second time in a row, and look forward to doing it again.
Sounds great. Thank you.
Thank you.
All right. So we are going to